Welcome, everybody. We are starting our part 6 of steering your business through COVID 19. I cannot believe we're on part 6 already. That's just kind of crazy to me. But that's that, I mean, there's been that much content out there, really. So, what we're going to talk about today is a little bit more of the same, a little bit more of some of the things that got breezed by a little bit when we were so involved in the getting of the loans and all of those types of things. There were some pieces of the legislation that really we didn't end up with a whole lot of uh, information on, or that we kind of glossed over. So we're going to talk about that as well. And I am going to pop over here. Let's see if we've got this sharing the right screen. Okay. All right. So today's topics, let's see if I can get this to move. Okay. All right, here we are. So here we are with our Friday lesson. We are talking today about some of those less prominent issues that were released with the CARES Act at the end of March. We're going to talk about the PPP loan forgiveness. There was documentation that was finally released regarding the loan forgiveness application, 11 pages, which I find kind of interesting because the application to get the loan was what, 2 pages, 3 pages, and actually the numbers part of that application was like 3 numbers. The rest was all certification saying that you should be getting this loan. So now we're to 11 pages. A lot of that is instructions. So we're going to talk a little bit about some things that the actual forgiveness application had given some clarification on that we need to know about right now while we're still spending the money. So we're going to talk about that a little bit. The next thing we're going to talk about that was part of the CARES Act that has been kind of glossed over a little bit, relating to the employee retention credit and the payroll tax deferments. So those could be situations that some people may be able to benefit from, primarily if you did not apply for and get a PPP loan, but there's some instances on some of this where you can have both. So that's what we're going to cover today. If you have any questions while we're going through this, please put them in the chat, and I will stop before we switch over to different topics and try to get your questions answered. So feel free to put those questions in, and we will answer them periodically throughout what we talk about today. I'm thinking we'll probably go an hour. I don't know that we'll actually go much past an hour unless there are quite a few questions. So, all right, let's dig in. All right, so the CARES Act, the other tax issues that have come up. So some of them were of the CARES Act was individual tax related, and that is where they identified the economic impact payments, the stimulus checks, and direct deposits that we all received in the last few weeks. But in addition to that, there were some other individual tax related issues, and some of that had to do with retirement accounts. And one of the primary ones is that you can take a retirement withdrawal out of one of your retirement accounts. And typically, if it's an early withdrawal, you will have a 10% penalty on that. And an early withdrawal would mean that someone has taken it out before they were 59 and a half and didn't have one of the already known exceptions for taking that. And there were some in the past, you could take money out, I believe, from some accounts for education expenses. You could take some out for there were at some point there used to be a way you could take some out for home, buying a new home. There's medical expenses. There's some exceptions there. But what the CARES Act did was expand upon that and says, okay, as long as you take out $100,000 or less, there will be no 10% penalty for if you have one of the two reasons: either you or your spouse or a dependent was diagnosed with COVID-19. And God forbid, I hope that that's not affecting anyone. But the other piece was if you were financially impacted by the pandemic in the sense that you lost money, you were furloughed, you had reduced hours, maybe you lost your job completely, maybe you have reduced revenue or income coming into your household. So what that means is you could take money out of your retirement for up to $100,000 without the 10% penalty. Excuse me. And you would, you have two things that happen on that. One, well, actually three, because the first one is there's no penalty. The second one is you have the opportunity during the next 3 years to put the money back in. So if you took the money out and you ended up either not needing it or you had a windfall at some other time, you could actually replenish your account without the limitations relating to typical annual limits. So, you could, if you took out $100,000, you could put $50,000 back in any of the next 3 years. The third part of that is that the taxes on that, so withdrawing from a retirement early means that you do have to pay tax on that, but they're allowing you to pay the tax over 3 years. So what that means, and I'm not sure how all the pieces are going to play together, is that if you withdrew $100,000 from your retirement accounts to help you get through the pandemic right now, you would pay 33 and a third thousand of you, that would be included in your income to pay taxes on at whatever your tax rate is when you file your 2020 taxes. How I'm not sure things will play well together is when you are allowed to put that money back in, does that mean that it's offsets the taxes? So I haven't gotten that far on that, but I have been able to tell that yes, you can spread the taxes out over 3 years. There's no penalty, and you could put the money back. So those are the three big things. So that's one of the things that affected individuals. Another one relating to retirement is that there are no required minimum distributions in this calendar year. And that was put into place so because of the severe drop in the market, there were so many retirement accounts took a big hit, and there was the side of that means that, okay, well, I still have this required distribution because I am over 70 and a half or over 72, because that law changed at the end of this year, or end of last year, excuse me. So they said, okay, you don't have to take those this year and you won't be penalized. And you won't have to make up for them in the next year. It would just be calculated based on the money that's in your account and the actuarial tables and all that good stuff for the 2021 year. So if you already took it, I don't think there's really anything you can do about that. You can't give it back, but if you haven't taken it or you're taking it in monthly payments, you could suspend those this year if you don't want to have to cash out of some investments at a losing rate. So, a lot of people don't want to pull out of investments right now because they're losing money on it. And until that market starts to come back, you kind of don't want to be pulling the money out because it's kind of in a situation where if you weren't forced to pull it out, you might not. You would leave it sit and let the market come back. So they're giving you that opportunity. A couple other related items to individual taxes that came up with the CARES Act is that they allowed what they call an above the line deduction for charitable, which means you can take a charitable deduction without having to itemize starting in 2020. However, it's limited to $300. So, okay, that's great, but it's so insignificant. I don't know that one, it'll stimulate people giving to nonprofit organizations enough that's not a big enough incentive, because $300 typically is, if it's a deduction, it's not going to move your tax liability at all. So it is there, but it's definitely not in a situation where it's going to be a huge benefit. I mean, $300. I was hoping it was going to be something more, $1,000 to $2,000 to $3,000, to really stimulate people continuing to give during this year when it's really a rough year for businesses. It's also a really rough year for not-for-profits as different sources of revenue are drying up for them. They're fundraising events, they may not be allowed to have right now. They can't have the galas, the balls, the golf tournaments, the all those things that are huge money makers for them. Um, to me, this falls a little short, but it is there. And my guess is, so if because of the tax law that passed in 2018, where the standard deduction went up so much, there are so many people who are still giving to charity, but they aren't getting any benefit to that. So there's a little bit of an incentive there to keep giving. The other two items relating to charitable donations are typically you are limited on your itemized deductions on charitable to you cannot give more than 50% of your adjusted gross income. It starts to be limited, and you would then carry anything that you gave in excess of that, you would carry that forward to future years. So they have lifted that 50% limit for 2020 for sure. So you could give 100% of your adjusted gross income. And as long as you have enough to itemize, then that's a huge tax benefit to you. So this is actually something that is could really benefit a lot of organizations this year. The $300 above the line, not a big incentive. But if you typically are giving to organizations and you are getting a deduction for that, and sometimes it is limited because your income is too high, might be the year to take advantage of giving a little bit more. In relation to that, businesses that gave charitable donations were limited to a deduction, especially for a corporation. They could only take up to 10% of their adjusted gross income in the past. And the CARES Act allows them to take up to 50%. So corporations are allowed a deduction of up to 50% for their charitable for 2020. So again, those couple of items may very well stimulate the giving. What's not so great is that all of the paycheck protection loans, the unemployment rules, all of these other things that they have put into place have really overshadowed those items. And so there's not been a whole lot of, hey, this is out there, let's take advantage of it. And so I really need to get to my not-for-profits and make sure they know that they should be touting this a little bit to their donors, so that they know that there's a little bit more of a deduction than was available to them in the past. So those are the things that I think really got glossed over when it relates to individuals. But I thought I'd go ahead and share that here because, everybody may, there could be a situation where, you're retired and you haven't taken your RMD and you say, yeah, I don't want to do that. Let's not take money out of a losing account right now. Or maybe you need your household's affected and you've got some money in retirement and you're looking at that and saying, okay, yeah, I could essentially take a loan out of my retirement account and actually get that paid back. So those couple of things are really things that I think would be beneficial to just know that they're out there and that you're keeping that in the back of your mind. So couple other business related items that were unrelated to the pandemic. And I'm not even sure where these came from. So a lot of times when the bills start to go through Congress and people start, adding things on, they want this and they want that, and they've got, somebody lobbying for this, and they keep adding things. And that's how we get bills that kind of include some randomness. And this was one that I found a little random, and I haven't done a whole lot of research on it, but there is the ability for an employer to pay a student loan for an employee. So I haven't, like I said, I haven't researched a lot about this, but it looked like there was a limit of up to $5,250, and they could either pay the employee for the employee to pay the loan, or you could pay it directly to the lender. I'm sure there are questions that would arise around that, as far as, okay, if you pay it directly to the employee, how are we deducting taxes? Do we deduct taxes? Is this taxable income to them? And as the employer, where are you classing this? How are you deducting this as an expense? The only thing that they said for sure is if the employer was the one who paid the student loan, the interest on that really can't be double dipped. So the employer pays some of your student loan, you get your interest statement at the end of the year. The portion that the employer paid, you can't get a deduction for. But I will tell you that so many people's income is so high, their student loan interest is not a deduction for them anyway. So that's an interesting thing. If you think you're an employer and you're in a situation where that could be beneficial, we definitely want to dig into what that would look like. So, okay. Another item, and it doesn't apply to too many people, but in the effect that you have a net operating loss. So that means in a year you had losses that exceeded your profit. There were some limitations that got put in place in 2018 relating to how much of those net operating losses you could carry back, carry forward. They were limited to, if you carried forward, you can only carry forward 80% of them. They lifted those restrictions. So what they've allowed is that if you had an NOL in 2018, 2019, or 2020, you're allowed to carry that back 5 years. And what they're hoping is that, okay, you go ahead and carry that back. You can apply for the refunds. So that way you can get some cash flow into your business. And it is not limited to only having an 80% use. You could use 100% of that NOL. So the 2018 legislation put in place that, you can't just keep generating NOLs and using them forever. They put an 80% limitation on that. So I can only really think of a handful of my clients that would have ever applied to in the past, but it's definitely something that if you're in that situation and your tax preparer had told you, yeah, we're limited, we can't carry these back anymore. That's something that you really want to investigate and go back and say, oh, maybe we should go ahead and carry these back, apply for the refunds, and not use it to offset future income. So that's how that would work. But that was also part of the CARES Act. That was, in my opinion, it was a little random. I understand from a cash flow perspective that would be something that could help stabilize the economy a little bit. But it was so buried in there, and so it gets a little complicated. So a lot of people don't even realize when they're in that situation. So you're really relying on your tax preparer to be aware of these things and bring them to your attention. All right, let me check in the chat, see if we got any questions. No, looks like everybody is good to go. All right, so we're going to move on to the next big topic, and this is the big topic. So everybody that has applied for or been applying for these Paycheck Protection Program loans, if you got one, you're kind of sitting there in the middle of it all going, okay, that's great. I'm going to use the money like Beth told me to. And then I need to know how we're going to get the forgiveness. So the Treasury Department put out their guidance that is on their website, and it is essentially it's an application. And the chances are the banks may come up with an electronic version of this. They may be, developing a portal behind the scenes where you can go in and drop all of the numbers in that this is requiring. But every single person who received the PPP loan will end up needing to actually apply for the forgiveness. And I am guessing your bank will be reaching out in some way. Your banks may be holding some sort of workshop, but what you probably need to know is that there has been some guidance that has come out inside of the instructions that really clarifies some of the questions that have been coming up about circumstances that could affect the forgiveness that we just didn't have any ideas on. So I've included a link here on exactly where the application can be found. But really, if you go to home.treasury.gov and click on the coronavirus relief, and I can just hop over there and show you that real quick. Let me stop sharing that. Hop over here somewhere. I think it's here. Share this guy. Okay, so if we went over to home.treasury.gov, and there's this red bar, and you click on the red bar. This takes you to all of the CARES related issues that are out there. And when you scroll down, you'll see a section called Tools. And in here is all of the final rules, the interim final rules, the guides, the applications. So right here under For Borrowers, the very last one is the loan forgiveness application. So we're going to talk a little bit about some of those items that are in this application that really did some clarifying for us. So let's make this guy bigger so we can all see it, and turn off my video if I can. Oops. All right, so here we go. We have this application. It's 11 pages long, and a lot of it is the instructions. So there are going to be some options as far as some date ranges you can choose. There are going to be some options that are going to be related to calculating your full-time equivalent employees in order to determine what your forgiveness amounts are. But the main ones that I identified relating to this, let me jump back over here. Go back. Here we go. So it's really this instruction relating to what expenses are going to be forgiven in, is it what is paid, or what is, you know, so especially when it comes to payroll, are you being forgiven for the hours they worked or the hours they were paid for? And I have been telling people, you know, I think the most important piece of this is that you need to spend the money. So I'm going off of the paid portion of it. And the explanation actually got very clear and says it is what was paid during the time period and what was incurred. And what it says as far as incurred is, if you are, let me find my section, I think I've lost it already. If you are, you have a pay date, that payroll is included in the forgiveness as a payroll cost. And then the hours up until your last date of the 8-week period, those hours would be included as payroll as long as they were paid by the next pay date that you on your pay schedule. So you couldn't just say, oh, they accrued, you know, an extra, you know, 40 hours here, and you didn't pay them for it until the end of the year. You're trying to accrue their bonus. That doesn't work. But what does work is, so say your pay period, you have a pay date of today, and you pay every 2 weeks, and you're going to end your PPP 8 weeks next Friday. So there's this whole other week of work, but they don't get paid for another, you know, 2 weeks from today. So they're getting paid, you know, in June, and your date has already expired. You're going to go back, as long as you paid them on the next available date, you can include those incurred hours as part of the payroll cost. So that is definitely some guidance that I think is super helpful, because there's been a lot of talk of, do I move my pay date so that I can fit it in here? Or can I, should I, you know, accelerate paying somebody's vacation? Should I, you know, any of these things? And so I think what is happening is, it is any date, pay date. So what if you got funded today and it was a payday? Well, that gets included, you know, that gets included as a payroll cost. So I'm telling you, it's going to be in calculating it, it's not going to be as simple as just saying these were the expenses that were paid. And it adds another level of complexity to it, because you, in order to get to the 75% that allows you full forgiveness, you want to take advantage of all of the expenses you possibly can. So the other thing they're going to give you a choice on is your covered period. And essentially your covered period, everything has been said, is from the date it was funded until the 8 weeks later. So from the date you were funded until 8 weeks later is your covered period. And that's the time period that you would be turning in expenses to be forgiven. Well, they're allowing you an alternative period in case you started your funding period at a time when maybe you got funded and the end of your pay period wasn't for a few more days, and you want to change your cutoff date essentially. So I think for some people, this is going to be a calculation, especially, depending on how frequently you pay. Your weekly people aren't going to see much of an effect, but your biweekly or semi-monthly people, we may definitely want to look at this alternative payroll covered period. And just to give you an example of, what, why I'm saying this is complicated, is I'm just going to read you what it says for the definition of alternative payroll covered period. And it says, for administrative convenience, borrowers with a biweekly or more frequent payroll schedule may elect to calculate eligible payroll costs using the 8-week, 56-day period that begins on the first day of their first pay period following their PPP loan disbursement date. So essentially they're saying, instead of the day you got your money, you're going to begin it on the first day of the first pay period following that. So that could buy you some time. And then it goes on to say, for example, if the borrower received its PPP loan proceeds on Monday, April 20th, and the first day of its first pay period following its PPP loan disbursement is Sunday, April 26th, the first day of the alternative payroll covered period is April 26th, and the last day of the alternative payroll covered period is Saturday, June 20th. Borrowers who elect to use the alternative payroll covered period must apply the alternative payroll covered period wherever there is a reference in the application to the covered period or the alternative payroll covered period. Does that not want to make your head explode? So I'll just tell you, I read through this entire document twice now, and there's so many areas of it that I read it and then I have to reread it. I'm like, what are they talking about? And it's complicated. So it's not just straightforward enough to say, hey, here's my receipts. It is going to be, you are doing the calculation, and it's the borrower's responsibility to do the application. So it's going to be a little crazy. The other piece of this is your full-time equivalent calculation. That's two things can reduce your forgiveness amount. One, not having your payroll costs be at least 75% of the money used. And two, not equaling or exceeding the full-time equivalents for your employees, because the whole purpose of this was to save jobs, keep people employed. And so they're giving you two full-time equivalent calculation options and a couple of choices on what period you want to compare to. So, so far I've said there's 3 different things that have multiple choices for calculation. And so this process is going to be pretty extensive for you to figure out what's the best thing to do. So your full-time equivalent calculations are essentially, looking at the average hours somebody worked in a week and dividing by 40. And then rounding to the nearest tenth is one choice. And the other choice is saying, okay, everybody who worked 40 or more hours in a week equates to a 1, and everybody who worked 39 or fewer hours equates to a 0.5. So for some people that will be beneficial, especially if they have a bunch of people that work a low number of hours. So maybe you have some 10 and 15 hour a week people. That's not even getting to a half a person. So if you choose to use the straight 40 or more is 1 and 39 or fewer is a half, you might be in better shape. So the other thing that came up, and I've had several questions from clients regarding this, is what happens when I try to rehire somebody, I try to bring them off of unemployment, and they decide they don't want to come back. and they were full-time. That's going to affect my FTE calculation. What if I needed to fire somebody for cause? They're stealing from me. I gotta let them go, but I'm going to hang on to them because it's going to affect my forgiveness amount. That's crazy. But up until now, we didn't have the super clear guidance for employers on figuring out what are you doing with people who refuse to return, people you need to fire, and people who quit. And those are exceptions that will not affect your full-time equivalent calculation. And so the biggest piece on that is you need to document it. You need to document that you offered them their job back and that they refused. You have to document that they quit and you have their letter of resignation or whatever. You need to document if you fired somebody and what the reason was. And that is not actually documentation that has to be turned in with this application, but it is documentation you need to retain with the documents that you use to prepare the application. So that's great. So we're looking at, okay, I can actually run my business like I normally would without fear that that person didn't come back. Because that's happening right now. Some people are, they're refusing to come back, maybe out of fear. They might be refusing to come back because they're making more on unemployment. And we've had this discussion. That means they quit. So you have to report that. But yeah, so now we have the ability to have a calculation, and this application will have a place to list your people who, didn't come back or you fired or whatever, to explain your FTE exceptions. So that's pretty exciting. We finally have some clarification there. The last piece relating to this forgiveness is something that's come up in recognizing that how you applied to, like how you did your calculation to apply for the loan, you applied for a portion of payroll costs, and how they're asking the forgiveness are two different calculations. So when you applied, you were told, okay, take your 2019 wages, divide them by 12 and multiply it by 2.5, because that represents, 2 months plus an extra bonus half. So 2.5 months of your payroll is what we're going to give you. But what we're going to forgive are your payroll costs that are incurred during 8 weeks. And 2.5 months, we know exceeds 8 weeks, but even 2 months can exceed 8 weeks. So you actually, and the calculation absolutely is what is happening during this 8-week time period. And so that's where some of these things are going to be super important for you to make sure you've made your right choice on your covered period versus your alternative covered period. Make sure you're, doing your comparison to prior years, that you're picking up your paid and incurred. All of these things are going to come into play because you were given more money than you really technically should be able to use in 8 weeks. So that's becoming an issue. And so I said from the get-go, if you can't afford to have the loan, don't apply, because there's going to be a portion that is not forgiven and is going to be a loan to you. So it'll be a small loan, because there's going to be a big portion forgiven, but it's going to be a loan. It's only at 1%. You don't have to make payments till, starting sometime towards the end of the year. But you really, when you think about it, they did not do the calculation consistently between how you applied for it and how you're getting forgiven for it. And so shame on them for, one, releasing the applications to get the loan so quickly that they didn't have any real idea of what they were doing. And then two, for not making, when they had the opportunity to draft the forgiveness, that they didn't make it the same. They didn't make it consistent. So shame on them. That's my opinion anyway. So but that's a lot of pieces to be looking at on that forgiveness, but hopefully that gives a little bit of clarification for some things that we were worried about, like quits and fires and, didn't want to come back type things. One of the other things that I noticed on here was we've talked a lot about what is included in that 25% of other qualified cost category. And it was defined as, mortgage interest on the building that you own for your business, rent, and utilities. So in their definition of rent, it says business rent or lease payments for real personal property. For real or personal property, I should say. So that means your rent payment, but that to me would also include your equipment payment. So say you're leasing a copy machine, you are leasing some sort of other off your telephone system, there could be some lease payments that and maybe if you're leasing vehicles through your business, you would be entitled to use those as part of that 25% as long as the leases were in place before February 15th of 2020. So that was interesting. I didn't really consider I was that personal property side of that, but that would be your vehicles, that would be your copy machine, that would be really anything you might be leasing inside of your business as far as operating equipment. So keep that in mind. That is that kind of opens me up to really be questioning some of my clients as far as, oh, is this a lease? The thing they did identify, and I was suspecting that they would, is that part of the forgiveness package will be that you need to provide them with your lease agreements. So I would tell you right now, start digging, find your most recent lease agreement that was in place prior to February 15th, because you're going to want to prove to them that you are paying things under a lease agreement. And on this one, I don't blame them. Because somebody could say, yeah, this is my rent, but they need it. They need proof that you really do owe this amount and you're not inflating it somehow, especially because a lot of people rent to their related party. So speaking of that, a lot of people that do rent themselves they own the building in a holding company. You want to make sure, for good business purposes ever, to have a lease agreement with yourself, because you never know what's going to happen. And this is the prime example of, if you don't do things as if you're in business with yourself, then you might miss out on opportunities to treat things like a business type of expense. So I know I have several clients that don't have a lease agreement in place with their real estate holding company. I'm not, essentially saying go back and dummy up a document. I think you may be able to get away with showing that you have been making these payments consistently over prior months and years. So by showing on bank statements, by canceled checks and those types of things, that clearly you were in an agreement to pay that company. But you might want to make sure that you have a lease agreement in place. And there's good reasons for that, other than just because we're looking at this guidance and this pandemic legislation. If you were ever in a position where you wanted to sell your business, they would need to know, a potential buyer wants to do their due diligence and see what lease agreements you have. And you definitely want to include yourself so that you have any contingency plans for, if they decide they don't want the building, they got to buy out the lease. That's already defined, all of those good things. So definitely put that on your radar if you are in that type of a situation, to work on making sure you get a lease drawn up with a legal entity so that it is taken care of in the future. But just know that if you do have one right now, you want to make sure that you are going to include that with your paperwork to prove that you actually had a lease prior to February 15th. The other things that they are going to be requesting, they're allowing utilities as part of your 25%. You want to make sure that they want to make sure those utilities were in place prior to February 15th. So they're going to be requesting the bill from February and the bills that were paid for the months that you paid them during the 8 weeks. In addition to that, they do specifically say for utilities, you can, if it's incurred, so it is you're paying, for utilities that incurred last month, and that bill is going to fall outside of the 8 weeks, that's going to be just like the payroll costs. You're going to, as long as it's paid on time after the 8 weeks is up, you're going to be able to include that utility payment. So it's It's complicated. It's complicated. That's all I can say. Um, so there's a lot. There's a lot. One of the things it is definitely doing is addressing there was some question about should we get the loan, should we not get the loan, um, because they came back and said, do you really need it? You really need to make sure you certified that you needed it. And that really, sounded some alarm bells with some clients that are like, well, do I need to give the money back? They got real clear on that and said, if you got $2 million or more, they're probably going to be looking at it. Anybody less than that, your certification was okay. Because they would assume that companies that needed less than $2 million didn't necessarily have any other fast way of getting funds into their business. And they're right. I mean, if you had to go a traditional route to get funds, it would take you much longer than some of these PPP loan applications took. So there is a question though on the forgiveness application, making you certify whether or not, you're marking the box, did I get $2 million or more on my loan? So that way they have a very fast way of auditing those people. The other thing I was going to talk about, I just slipped. What was it? Let me see if anybody has any questions. No, everybody's quiet today. Okay, so what else was there? There was something that was just there. It was about the $2 million, but I lost it. Oh, I remember now. The other thing you have to disclose on this forgiveness application is if you received the EIDL grant. So if you got the anywhere from $1,000 to $10,000 grant that just dropped into your bank account with no real explanation, may have said SBA on it, may have said EIDL. If that just dropped into your account and then you got the grant, that is going to reduce how much is forgiven. So if you got $4,000 and you qualified for $50,000 in forgiveness, you only get 46,000. So it is going to come right off of that forgiveness amount. So they'll do the whole calculation of how much you qualified for, and then they're going to add back what you got in that grant. So that's definitely not really a grant, but that is also keeping everybody from double dipping on that, because all the funds were coming from the same place. It doesn't have anything to do if you went through the steps to actually receive, to apply for and receive the EIDL loan, which is the 30-year loan at 3.75%. That is some calculation relating to your revenues minus your cost of goods sold times a percentage. We're still times a percentage, and then possibly your credit rating falling in there somewhere. You don't really get an explanation of how they calculated it. They just offer you a max. If you applied for and got approved and accepted that doesn't have anything to do with the PPP forgiveness, except in the standpoint of those EIDL funds should not be used for the same expenses during the same time period as the PPP. So you need to be using those funds for other operating type of expenses that are not qualified for the rest of the PPP money. So that's going to be paying your vendors for supplies. You're going to pay for, your manufacturing materials and your contract laborers and everything else. So and then once your 8 weeks is up, if you still have funds from the EIDL, you can use those for payroll. That's not going to be an issue. But just keep in mind, it's not so much that you have to earmark the funds and say, here's out of this bank account, I spent this, this, and this. It's more from the standpoint of you need to not be spending. You need to have enough in your PPP that it's just paying for payroll costs right now. So I have a couple of clients where their money sitting in the savings account, and each time they have a payroll, I'm just moving over that money to cover the cost to their operating account. So that way we have a little bit of control over that, but I'm not doing that for everybody. It's going to be pretty simple. I'm going to do a short video and put it out on my website probably this weekend on how to run a report in QBO and a report on desktop that is filtered for just the expenses that are relating to the PPP so that you can pull that up at any time. You know, you memorize it, pull it up, and you can see where you're at as far as your spending. Excuse me. Okay. Let's move on. What do we have? Oh, okay. So there's a couple of items also that was in the CARES Act. That is the employee retention credit and then the ability to defer some employment taxes. So these two pieces ultimately affect the Social Security portion of your payroll taxes that is owed by the employer. So the employee retention credit is first, if you got the PPP, you can't do it at all. So, but if you didn't apply for the payroll paycheck protection program loan, what this is allows you to do is essentially get a credit for up to $5,000 per employee against your Social Security taxes. And you would take that off of your 941. You'd reduce your 941 taxes, and it ends up being a refundable credit. So if you actually it wipes out more than it should, you get, you end up getting the money back. So, or they're gonna give you money. So it's not going to affect most of the people because it is completely eliminated. If you got the PPP, you don't get to do this at all. But it's really designed to help cash flow. And what I can say is, so the Social Security is 6.2% of gross wages. And for some people, that's just not going to be a big enough thing to be worrying about for the amount of calculation is going to be. So, and then, like I said, if you got the PPP, you stopped listening already. The second piece of this is the employment tax deferments. They're allowing you to pay some of your payroll taxes late. And again, it's the same portion of the payroll taxes that is part of the retention credit, which is the 6.2%, the employer portion of Social Security. You could not pay that beginning March 12th, I think it was. You could just stop paying that to help your cash flow. And then whatever you deferred, you would need to pay at least 50% of that deferment by December 31st of 2020 and the other 50% by December 31st of 2021. That's crazy to me because you still owe it. You're allowed, if you got the PPP, you are allowed to do this. You just take these amounts off of your 941 payments up until the time your forgiveness is approved on your PPP. So you could be doing it right now. Nobody's been forgiven on their PPP yet. Nobody's 8 weeks has expired yet. So you could, and this is something that you would calculate on your 941s. The 941 forms are definitely going to get trickier come third quarter. So if you're filing your own or calculating your own, it might be time to get some assistance with that. So those are a couple of pieces that were in the CARES Act. We didn't talk a lot about it because it was the PPP overshadowed everything. But if you're still in some cash flow, situation where you would prefer to defer because maybe your cash flow picks up later in the year, you could start paying that back toward later in the year and stop paying that portion right now. It's definitely an option. Definitely an option. So all of the information about the employee retention credit and the employment tax deferments are on irs.gov. And there's lots of frequently asked questions about those in there as well. All right, so I'm going to see if anybody had any questions from the Facebook feed. First, let's see. Scrolling down and okay, here we go. Oh no, stop. Don't talk. If you're filing your own. Okay. I just want to see my comments, people. Seems like that would be way easier to do than it is. Okay. comments without speaking. Okay. All right. Is that EIDL money coming off the 75% or the 25%? Okay, so keep in mind the EIDL grant, it's not coming off of either percent. You calculate everything as if you didn't get it, figure out what your forgiveness is, and then add that back. That's exactly what's going to happen. It's not part of the payroll costs. It's not part of the other costs. It's okay. I got $50,000. I did all my calculations, and I get 48,000 of that forgiven. Well, too bad. I got a $10,000 grant. I now have, instead of having $2,000 loan, I have a $12,000 loan. So yeah, there's a lot of, that's the catch. It has nothing to do with, your initial $50,000. 75% of that 50,000 is what you're aiming for your payroll costs, regardless of what you got from the grant. You are stuck with that. You don't get to take it off of the top. You're taking it off of it. You're adding it back to the bottom is really what is happening. So that is definitely a tricky part, because people are thinking, yeah, if you had the opportunity and you boosted your staff and you're going gangbusters, and you were able to pay more than 75% in payroll costs, maybe you paid 100% in payroll costs, then that whole thing would be forgiven. But if you got the EIDL grant, that is the fixed amount that they just sent, you will have to pay that back if you got the PPP. So it'll be at 1%, and the payments won't start until 6 months after you were funded. So yeah, so the calculation is definitely, it's after the fact. You do all the calculation first, and then you end up adding that back on. So, and that is part of the forgiveness application. There's a place to list how much you received, and there's a place to add it back. So good question. All right, I don't have a lot of questions in here from anybody else. I still have my list of reliable resources out here. The home.treasury.gov is on here, and those should be clickable links when you get the slides. What I am doing and offering is I have created a Forgiveness is Hard workshop, which is going to be a paid workshop that is going to have the detailed instructions on how to actually fill out the PPP forgiveness application. There are lots of moving parts to this application. And so this workshop is going to be, 2 hours in depth of how to calculate and fill out each line, and what reports are you going to be using in QuickBooks to get this information. And we'll kind of run through a kind of a case study as somebody who is completing the application, and where are they getting the numbers. So that workshop is scheduled to be done on June 3rd. It'll be a Zoom just like this, but it will not have a live broadcast. It's a paid course, and it will be a closed course. So it's only for the paid participants. Afterwards, you will get the entire replay, as well as all of the schedules in Excel, the templates, in order for you to drop in your own information and get your own calculations to fill in the application. The cost is going to be $97. And then for a select few, I think I have about 10 spots left. For an additional $100, you'll get a private one-on-one Q&A session with me to go over your application and any additional questions you have before you file it. So all of those Q&As will be scheduled after your 8 weeks has expired and you're ready to actually complete the application, so that in our Q&A session, we can actually get the real numbers that if you need help. I put the link here too. It's off of my website, wlxco.com. // I never know what those are, PL/176679, and you can go there and register. It will be open to the public. So I will be advertising this. So if you want one of those private one-on-one sessions, those are going to go pretty quick. So, and you want to get those, get that paid for so that we can get it scheduled. So that, like I said, that is coming. It's going to be on June 3rd, which is a Wednesday. That'll be right around the time, people are the early recipients are going to be starting their application process. So they opened the first PPP round on April 3rd. So people will be that week, they'll be finished. Nobody got their money on April 3rd. That was the day they opened it, but they got it the next week. And so people will be winding up their 8 weeks in that week. So it'll be very timely for that. I'm still going to come live to you for the regular Steering Your Business workshop next week for sure. But it will be at a different date. It will be on Thursday because I will be traveling on Friday. So I'm super excited because we actually are going to a race. Normally we are out of town for Memorial Weekend, and we are definitely not going on that big trip. It'll be like the first time in 20 years at least that we're home for Memorial Weekend, but we are going to go out of town for a race next weekend. So I won't have a good signal. I think I'll be on the road actually at 1 o'clock on Friday next week. So I'm going to do it Thursday at 1 o'clock. We'll have another workshop and see what other new and exciting items have come up for us to review and look at and have questions about and address and all of those good things. So like I said, this replay, I will upload. As always, ways to stay connected, the Facebook page, I'm always there. WLX Co also has a Facebook page, and I'm feeding things over to that as well. And then I did add here at the bottom of this slide, if you've missed anything that we have gone through, whether it was a Facebook Q&A session or one of our Steering Your Business webinars, they're all on my YouTube channel, and I've included the link here as well. So if nobody has any other questions, then we're going to wrap it up for today and go and enjoy a little bit of sunshine before the rains start again. It's going to be warm this weekend, and I hope everybody has a happy and safe Memorial Day. And I enjoy your time off if you're getting it, and enjoy the warm weather because it's supposed to be kind of hot this weekend, and I'm so excited.